I feel privileged and honored to have the opportunity to briefly introduce our eminent speakers to you all in the order which they have invited to the dais. At first, I brief about our one of the eminent speaker present on the dais, learned senior advocate Sajan Kumar TULSIYAN sir. Sir is one of the legends in the direct tax profession and we are all very much familiar with him. He has obtained LLB degree in the year 1973 from the Calcutta University and practicing as an advocate in the direct tax field for last 48 years. Sir has been a regular speaker at various conferences, seminars, meetings of various professional bodies on the diverse issues in the field of direct taxation across the cities. He has held and continues to hold in the eminent position of the tax bars throughout his professional journey. We are feeling privileged that he is the president of our esteemed organization. Sir, your commitment and dedication towards the organization and legal profession is a remarkable one. Finally, you are the inspiration for all of us, and for his honor, please give a big round of applause. And in continuation, I briefly introduce about our next eminent speaker present on the dais, Sri Ashok Jha. An officer of the 1919 batch of IRS, superannuated on 30th September 2025. His final assignment was as CCIT, Mumbai. Sri Jha graduated from Hindu College, DU, and pursued his postgraduate study at JNU. Over the course of career spanning for more than 35 years, Sri Jha held several challenging assignments across the country. He began his career in Kolkata, where he served for 12 years, including 6 years in the investigating wing, during which he had number of landmark investigations. He subsequently served in the Bihar and Jharkhand for 4 years and for more than 3 years in NER. At NADT Nagpur, he served for 3 years as a trainer and he has mentored numerous officers now posted in the all over the country. In the 2024-25, Sri Jha was a member of core committee constituted for drafting the Income Tax Bill 2025. In recognition of his exemplary contribution, he was awarded the certificate for exceptional and meritorious service of the Honorable Finance Minister beyond the professional commitment. He also enjoyed for playing badminton and billiards and at last you are sir diversified qualities and inspiration to all of us, and for his honor please give a big round of applause. And now, in continuation of same, I introduce our moderator present on the dais, Advocate Subrato Rai. He was obtained the LLB degree from the University of Bardhaman, securing first class and first position. He is very old, well-known practitioner in the field of direct tax and indirect tax for last 38 years. He has held and continues to hold the eminent post of tax bars and social organization throughout his professional journey. We feel privileged and also a founder member of the esteemed organization. Sir, we are ever been grateful to you for your remarkable contribution not only towards the legal profession but the society as a whole. And for his honor, please give a big round of applause. With this, we wish you all power-packed and knowledge-enriching Sunday ahead. Now, without further delay, I hand over the mic to our moderator to start the session. Thank you so much.
Good afternoon, friends. Now we are going to start the last session, that is the income tax session. And as we know that our topic is the new Income Tax Act vis-a-vis the comparison with the old Income Tax Act 1961. Actually, first I start with some words of, as we know, that famous American scholar, Mr. Roscoe Pound, who said that law is nothing but instrument of social engineering. And he stated that law should aim to satisfy the maximum aim of human wants and needs with the minimum amount of friction and waste. So the aim of the law always is the shaping of the law according to the wants of the society. And in view of that, as we know that new Income Tax Act 1925 has replaced the old Income Tax Act, which is repealed with effect from 1st April 2026, after a long period of 6 decades. Actually, the old Income Tax Act was replaced by the new Income Tax. As we know, that old Income Tax Act was becoming very voluminous with the lots of amendments, explanation, provisos and some of the redundant sections. In order to reduce the confusion or reduce the voluminous of the act, the new act has been entered with some fewer sections and lesser schedules, rules and everything. And accordingly the income tax rules also been in the same pattern. Income tax rule 2026 also been amended, also been replaced by the old rule 1962 rule. So this new, now we know that in the transitional phase, that is the most crucial thing. That is, old act has been replaced by the new act. So there is one transition, and what is the most important aspects of our topic in this house today. And we have with us two erudite speakers. One is our beloved President, Mr. S.K. TULSIYAN, and another one is one of our retired Principal Commissioner of Income Tax, Mr. Ashok Kumar Jha. They will explain. First, I will ask our President, Mr. S.K. TULSIYAN, to enlighten us how the transition process is going on and why the new act has been replaced by the old act. And our session, as because it is the last session of the house, so we want to minimize our session. So time allotment for both the speakers, we have to restrict this because most of the it is a long time hour of session is going on. So keeping in mind, I request our beloved President to come and speak on this topic.
Respected moderator, the eminent guest speaker, Sri Ashok Jha, the retired Principal Chief Commissioner of Income Tax, my esteemed colleague from various parts of the state of West Bengal. It is a remarkable occasion to be here amongst all of you in a place like Digha, which is a place of happiness and joy because of the overflowing sea around us. But we are with a serious subject with you. It is always a privilege to be in a room. The quality of thoughts matches the importance of the subject. I believe really is going to be one of the thrust of today's topic. We are gathered this afternoon to discuss something that every one of us are interested to know, because the subject is going to affect our life and our profession greatly. The issue to be noted is that to meet the ever-growing requirement, the government decided to come out with a new law which has now been enacted, robust enough for the proper collection of direct tax. Is it simpler, clearer and more effective than what it replaces? That is precisely what today's discussion is about. Income Tax Act 2025 comes into force on the 1st of April 2026. The ink is barely dry. Interpretation have not yet been written. Precedent have not yet been set. What we discuss in room like this, one will say how this law is read and applied for the next generation. We are aware that although the government came in the month of August with this law, but in the finance bill which came in on 1st of February 2026, age 86 amendments are made in this new law. So I am very apprehensive that the purpose for which this new law has been enacted, will it see the similar type of amendments which will make this law also accordingly complex and will not be having a universal application for decades to come. The 1961 had long and complicated life, amended nearly 65 times over 6 decades, growing from manageable statute into 819 sections across 47 chapters, 500,000 words of dense, layered legal text, provisos, piled upon provisos, and somewhere along the way, the law began to speak in a language that required a specialist to translate before a citizen could understand it. So this was the law which replaces the new law. The Income Tax Act 2025 appears to be a serious, carefully considered attempt to reverse this journey, but for the fact which I narrated in the Finance Bill Act 2026. It does not change tax policy, it does not alter tax rates. What it does is take 64 years of accumulated complexity and restructure it into a framework that is coherent, accessible, and built for a century we live in. Sections reduced from 819 to 536, chapters from 47 to 23, TDS provisions consolidated under a single section, previous year and assessment year replaced by a single tax year, virtual digital assets formally integrated into a statutory framework for the first time. Following the Finance Minister's announcement in July 2024, CBT undertook a comprehensive review. The bill was introduced, referred to the Parliamentary Select Committee, revised on the basis of over 285 recommendations passed by both houses and received presidential assent on 21st August 2025. 3 principles, according to government, anchored the exercise: simplification, policy continuity, and rate stability. The goal was not to overhaul the tax, but to overhaul the tax experience. To take us through the architecture, the innovation, and the questions that remain open, we are privileged to have with us today Sri Ashok Jha, the former Principal Chief Commissioner of Income Tax, Mumbai, someone who has seen this law in the youth and watched it to grow into a complexity of provisions and have experienced the same. These are no other better place to guide us through what the 2025 Act set out to achieve and what it means when tested in practice. I would particularly require him to address certain very important issues in the new law, to which the public in general are really concerned with. In search and seizure, particularly, the digital economy has been brought in. Now, search and seizure for the digital economy has come into place in place of the paper-based economy. So, therefore, what will be the impact of that? The overriding password versus breaking open locks, these are the two different things, because now overriding password has become more important then breaking the open locks. Earlier, the locks used to be broken in person. Now, when passwords are overridden, then everything is exposed, right from your privacy to your asset. The virtual digital space, where does the search end? Once you have got the details of my virtual passwords, then your right to know about me continues in spite of the fact the search ends. So therefore that will be a very important issue which has to be examined in the light of the new law. 2025 Act significantly expands who can be examined on oath during search. Section 247(6) now including accountant, machine operators, gatekeepers, quality control persons and any other person present in the premises can be examined. What is the significance of these statements which shall take place during the course of search under section 247(6)? What will be the evidentiary value of that? Does 247 survive the proportionality test? That will be another very important thing to be understood in the context of the new law. What concrete mechanism has the department put in place to ensure that search targeting undisclosed income does not become a wholesome invasion into the citizen's personal communication, medical record and privileged correspondence? And if no such mechanism exists, how does the section 247 survive the proportionality test? These are the very important questions shall have to be seen. We also have to understand the changed scenario in respect of the replacement of the restrictive proviso to section 215 of the Income Tax Act in the case of the NGOs. Now, the organizations who used to lose earlier the charitable status under the 2025 Act, they have to pay the tax and will not lose that. What will the significance of that? That also shall have to be seen. The point to be noted is that this Act came into force from 1st April 2026. Just weeks ago, the real test of any law is not in its drafting, but in its application. What is the one provision in the Income Tax Act 2025 that you believe will make the single biggest practical difference in the life of the taxpayer? That is another important point which has to be answered by him. I'll now shift, leaving these issues to Sri Ashok Jha. I'll shift my attention to the repeal and saving provision contained in section 536 of the new Income Tax Act 2025. The point, the first subsection of section 536 says that nothing shall affect the previous operation of the replaced Income Tax Act and orders or anything duly done or suffered thereunder. Means it is the old orders passed are preserved and its operation shall continue. Subclause B says nothing shall affect any right, privilege, obligation or liability required, accrued or incurred under the repealed Income Tax Act or orders under such repealed act. It means protection of vested right and duty to carry on the liability suffered therein. Then the provisions of the repealed Income Tax Act shall continue to apply to any proceeding pending on the date of commencement of this act and to any proceeding initiated on or after 1st of April 2026, including notices, assessment, reassessment, recomputation, rectification, penalty, reference, revision and appeals in respect of any tax year beginning before 1st of April 2026, and such proceeding shall be carried out as per the procedure specified in the repealed Income Tax Act. It means all the past assessment years prior to 31/3/2026 shall continue to be governed under the old law, including 264, including 263, including 147 read with section 148, including the pending appeals which are lying with the CIT appeal, or including the appeals lying in the ITAT, High Court and Supreme Court. So everything relating to the period prior to 1/4/2026 shall be continued under the old law of income tax, which is Income Tax Act 1961. So both the parties will continue to be affected by the continuation of this proceeding. So there should not be any confusion about it. So this 2026 Act presently applies to survey, presently applies to search and seizure, presently applies to summons which are being issued, presently applies to the deduction of tax at source, presently applies to the payment of the advance tax, presently applies to preparation of accounts, and since it shall be tax year now, the return which we will be submitting will be 26-27 accounting year, which shall be the first year for the purpose of the filing of return under the Income Tax Act 2025. All other earlier acts and actions which has taken place or which will take place, even including the filing of return up to 31/3/2026, will be under the repealed Act 1961, because the saving clause gives that power to the department, as also the duty to the assessees under the law. Any proceeding for imposition of penalty in respect of any tax year beginning before, so likewise the penalty proceeding will also continue like that. Any proceeding pending on the commencement of this act before any income tax authority or any other authority constituted under the repealed Income Tax Act, appellate tribunal, or any other court by way of application, appeal, references I have already told you. Then any election or declaration made or option exercised by an assessee under any provision of the repealed Income Tax Act and in force immediately before the commencement of this act shall deem to. So all the options which you have exercised, where you are directly agreed not to take the benefits of exemptions, etc., and take that provisions, these will all continue without any disruption. Where in respect of any proceeding relating to any tax year beginning before the 1st of April 2026, refund falls due on or after such date. Now in respect of the refund, they have said that up to 31/3/2026 the rate of interest which is prescribed on the refund shall continue, but post that the rate of interest will be payable on the basis of the new law, not under the old law, because earlier when the statute provided for a particular rate of interest to be paid, then that will continue to play force till the final act under for that proceeding are not concluded. So note that is the change which has been brought about. So therefore now interest shall be paid on the basis of the amended law, not on the basis of the old law after 31/3/2026. In respect of even the pending matters, where any sum has been allowed as a deduction or has not been included in total income of any person, either on account of fulfillment of some conditions or for any reason of any tax year beginning on 1st April 2026, and such sum was required to be included in the total income in the subsequent tax years, including the beginning of on after the 1st of April 2026. Under likewise say you have decided to invest the capital gain. For that you have made investment in fixed deposit or the required securities, and that you have to comply within 2 years from the end of the assessment year in which you have sold the property. That will continue to apply. Likewise all other undertakings which you have given under the old law will continue to apply under the new law. So therefore all that which you have promised to do or the government has promised to do will continue to be dealt with as per the old provision of the Income Tax Act. Any sum payable under the repealed Income Tax Act may be recovered under this Act without prejudice to any action already taken for the recovery of such sum. So all the old outstandings will be the outstanding under the new act also and will continue to be realized. Likewise, any agreement entered into, appointment made, approval given, recognition granted, circular, direction, instruction, notification, order or rule or any scheme framed therein issued under any provision of repealed Income Tax Act shall, so far as it is not inconsistent with the corresponding provision of the Act, shall deem to have been. So, all the notifications, all the circulars, all the government notification which has been issued by the Central Board Direct Tax or the central government will continue to apply to the provisions under the new act under section 2026 also, unless there is a change or there is any inconsistency in respect of those provisions which were there prior to the enactment of the Act 2025. Now, the amount of credit in respect of tax paid allowable to be carried forward for the case under section 1(j), JD, repealed Income Tax Act will again, all the MAT payments which you have made will continue to be allowed to be given credit to you in the assessment under the new act. Any amount of loss under the source head of income specified under clause B of the table given below and referred to in the section repealed Income Tax Act specified in the column C of the said table brought forward of the next year beginning with the 1st April 2020 had the Income Tax Act 1961 not be repealed shall be set off. So carry forward of the losses will also be in the same manner as it used to be done prior to the enactment of the new law, even under the new law. So therefore, you are not going to lose the benefit of the carry forward losses and carry forward depreciation. Then N, any amount of loss under the head capital gain, whether related to long-term capital asset or short-term capital asset, referred to in section 74 of the repealed Income Tax Act brought forward from the tax year, beginning of 1st April had the Income Tax Act not been repealed. So similar provision will be in respect of capital gain tax, both short-term and the long-term. Any set-up or loss or allowance for depreciation, so similar provision is in respect of depreciation. Any set of accumulated loss on absorbed depreciation in respect of cooperative society will be the same. Like any amount of profit gain arising out of transfer of capital asset not charged under the head capital gain by virtue of the provisions of section 47(4), 5, 12, 13b, 14 or repealed Income Tax Act in any tax beginning the 1st of April 2000 shall be deemed to be income. So earlier, whenever you violated these specific exemption granted under section 47, then 47A used to come into play, and then those used to be brought to tax because you violated that. That will continue to apply under the new law also, where any allowance or part thereof under section 32 to 35(4) of the repealed income tax is to be carried forward to the tax year beginning on the 1st April 2026. Had the Income Tax Act 1961 not been repealed, then the allowance or part thereof shall be added to the amount of capital allowance referred to in the corresponding provision of this Act and for the tax year beginning on 1st April 2026 and deemed to be part of that allowance, or if there is no such allowance. So likewise in the depreciation, we always consider that the depreciation which has not been absorbed shall be continued to be the depreciation of the current year and shall be allowed a deduction in computation of your income irrespective of the fact the period for which that's the depreciation being carried forward. Same provision shall continue under the new Act also. Now, credit balance in the provisions for bad and doubtful debts account under section 36(1)(7)(a) repealed Income Tax Act standing on the first day of the beginning of the year 2025 shall be added to the amount credited to the provision for bad and doubtful debt accounts referred to in the corresponding provision of this Act for the tax year beginning of the 1st of April 2020 deemed to be part of the amount credited to the provision of bad and doubtful debt account, and if there is no such amount credited to that tax year, be deemed to the amount credited to the tax year. So, like in the case of the bank or in the case of the finance companies where 36(1)(7)(a) deductions are allowed on the basis of percentage of the amount lent, age, bad debt, and that shall be that is added to the total provision having been made, that shall continue to be done in under the new law also. Any scheme which has been notified under the provisions or repealed Income Tax Act with a view to eliminate interfere with the SSE or any other person, the said scheme shall deem to have been made under the corresponding provision of this Act or under section 532 where there is no such corresponding provision and shall continue to be forced accordingly. So any notification which has the effect of providing the SSE certain benefit shall continue to be applied. Where search has been initiated under 132 or equation of 132A prior to the commencement of this Act, the provisions of repealed Income Tax Act shall continue to apply to any proceeding connected in respect of any search or equation, as the case may be, as if the Act has not been enacted. So, where the search has been conducted prior to 1/4/2026, that shall continue to be dealt with under the old Act of 1961 and it shall be treated as if new Act has not been enacted. Say, the search took place on 28th of March 2026. So, provisions of 1961 Act will apply and you have to file the block return after that within the prescribed time limit and shall be assessed accordingly. I shall have a question from Ashok Jha who will be answering on this, that post 1/4/2026, when the search takes place, you again have to file the block return. In the block return, you have to take the 6 years preceding income of the assessment years and the undisclosed income which has been discovered therein and of the year which is on the date till the date of the search. The question arises, how would you take those incomes in the block return on the basis of assessment year, on the basis of financial year, or on the basis of accounting year, or it shall be assessment year only plus that, and accordingly the block return shall have to be filed. This is another issue which will be have to be seen. So the government having enacted this section 536 has ensured that the Income Tax Act 1961 shall continue to operate for time to come and its implications shall continue to be felt. The appeals, tribunals, High Court, Supreme Court under the older provisional law continue to do their work in the field under the Income Tax Act 1961 and gradually this 1961 Act will evaporate, maybe in a process of 3-4 years. By that time when the Income Tax Act 2026 will become very operational and the old proceeding ultimately gradually will die. So with this, I'll leave the court to Sri Ashok Jha because I have to leave the hall by 3:45. So therefore, I have not entered into the other aspects of the new Income Tax Act and he has come with elaborate preparation. He will guide you by presentation as also through his speech and take you through the various provisions of the new Income Tax Act 2025 vis-a-vis the 1961 Act. Thank you so much.